All right, let's try and do this. Well, the conditions are quite windy, as you can tell, so I have quite a lot to say. Everything ranging from how everyone's are too preoccupied with Donald Trump opening up a criminal investigation against Jerome Powell, which, if you ask me, should have happened a long, long time ago. This is far overdue. And people who are not aware right now are probably staring at the pre-market, if at all. Those who don't realize at all what is the pre-market. Pre-market is that a derivative CFD contract, which is basically international, allows and facilitates the trading of over international sort of lanes. It used to facilitate mainly Australia, New Zealand, Asia, right? These countries, so they can trade after hours, overnight, basically. And those derivative contracts usually are the ones to affect how the market behaves at its opening. Now, I understand and I can see how they are overreacting over the news. And ironically enough, given where we are in the cycle already, and I can assume and assess that I can easily forecast and see how that will be part of why the market initially starts seeing more downside. But the irony is that people are not realizing that it's far more related to the cyclicality of the market. And that event may be just the little nudge, the spark that starts it all. While in reality, those who know what to look at, that Oanda contract, which I was mentioning earlier, the one that facilitates overnight sort of after-hour trading, that contract, actually, if you look at it carefully, you realize today we opened up with a tiny gap, which is very, very uncommon. Those who know, again, uncommon is a very interesting term within the sphere of the market, but still, let's stick by the most true statement about this, that it's very uncommon for these gaps to persist. And it does seem like the price action has started dipping quite rapidly at market at the beginning, at the opening, if you will, of these after-hour markets. And it seems that a lot of people are already, it's amazing how the sentiment shifts over within literal minutes, and those who were very bullish yesterday are bearish today. To the irony of that, which I'm not even going to sort of speak about, because those who know me better, know the community, know the idea of technical analysis, is that we are not bullish or bearish per se. We are whatever the market is telling us, what the cyclicality dictates, depending, of course, which is that you're looking at. If you're looking when at the end of the day, if we're looking at the larger cyclicality, at the end of the day, everyone's going to be affected. So that is kind of inevitable. What I want to address, I think, the most, and I will probably attach a picture with this video by the time I'll be posting it. I'll probably make it home, or at least be able to edit it on the go. As you can see, I'm not at home right now. And I will be able to show exactly that gap that I'm talking about. The gap itself is just basically a little bit of a leftover from the market open. Even the continuous contract is not completely continuous. It does take a break of an hour. And so within that gap, within that break, once the market opened up, which is very, very uncommon, if so, sometimes when that on the contract, the continuous contract sometimes has a tiny little gap, usually closes or gets filled right away. This time around, this contract just persisted for some very weird reason. It's very, very uncommon. But we do not ignore that. We do take and understand that there may be a probability that the market now will trace back towards market open hours, trace back up to fill that gap in, and then we'll continue downwards. But until then, we have to sort of keep our emotions at bay. And in reality, those who are more familiar with me and my thesis know that I've been calling for a market correction for quite a while. Some people got fed up with waiting and preparing and whatnot. And I get it. And I said right away that most people will not be able to do not have what it takes to last as long as the insanity may persist. Although what also most people do not realize, that the momentum, the positive momentum that people perceive to be so positive and strong, actually shifted over just a while back. And from here on out, there is no way back, really. I mean, there was no way back for quite a while now, really. The only thing that the market is structured in such a way that it's not about the day or the time period. It's about the processes within the larger process that needs to be accomplished. Once these processes are accomplished, unsurprisingly so, the market basically runs out of momentum, starts to fade, momentum starts to die down. The bigger institutions are more than aware of this as we're going towards this. And it is almost like the idea that the institutions put themselves very deep into that process and slowly start moving, slowly, step by step, moving from the edge of wherever that sort of idea of the sentiment is, slowly towards the door, step by step, slowly but surely, while convincing the average participant and the average Joe, no offense to any Joes out there, right, to start buying in once the Joes basically dip in deep enough and raise their own averages to the point where a tiny dip in the market, just the tiniest move downwards, will already put them in the red. And the irony of the circumstances that nobody will take this seriously, because we, myself, analysts, Michael Burry, Warren Buffett himself, we've been sort of warning and saying this. It literally became that wolf-wolf scenario, which we've been warning for quite a long time, that inevitably that wolf will come. And because it's taking so long, people now are not taking it so seriously. In fact, are shrugging it off and dipping themselves deeper and deeper while creating higher averages. And so, like I said, the smallest move downwards will put them in the red. And the irony of the circumstances, because how we already had the price action behave, these people will not take this drop seriously, not until before the price action drops below 4,800. Because that low represents to them something that the market can recover out of rather quickly. In fact, they saw it just recently. So in their mind, it's only after 4,800 when the market will dip below these levels and will persist there and will stay there. It's only then when the sentiment will shift over and they will realize that they're already also in deep, and they drag their averages with them as they're progressing, simply because they don't know any better. And from here on out, basically their portfolios are devastated. They're already 40% down. And given how they do not have anything technical to rely on, nothing to anchor themselves to, they will continue with this sort of faith idea that, oh, I hope and I believe everything's going to be fine. And once the market does end up at 3,300-ish level, as I've been predicting all along, and it will stay there for a little bit, of course, it's not going to be a, kind of hit and run type of deal. Most likely, we're probably going to be persist within these levels for a little bit. And that little bit is going to be more than enough. Again, when I say little bit, for me, it's a little bit. For the average Joe, it will feel like, 100 years or so, right? It will feel like forever and a bit, basically. Like the market has been dragging, will drag them out through the town, tied behind the truck, right? Kind of being almost, what is that? Devoured by the road behind it, right? So, I'm sorry for the ugly metaphor. It is what it is. But bottom line is, by the way, those who do want to know, I do teach in my community, and the community has been growing tremendously. Those who think I've been on a hiatus because of anything, I don't know, that I don't believe in my own thesis anymore, or that I don't think it's just the opposite. In fact, I was putting all my efforts into my community. In fact, I put most of the academy in text form, and that's why I highly recommend and invite everyone to join. Now is probably the best time to do so. Simply because once it already happens, maybe it will be very difficult to digest, and people will have very little interest in learning and understanding, because by the time it's just that literally is just the phenomenon that human behavior, sentiment involved type of deal that ends up happening with every cycle, and this cycle is not going to be any different, in fact, because most people are so far deep with any and most of their assets, and just very few are smart enough and have enough profits to make sense for them to actually lock in these profits, which is the smart thing to do. Again, not financial advice, just my own humble opinion based upon the technical analysis that I see. And very shortly, when the market will break, whether it's because of what's happening with JP and everything's going to revolve around the Federal Reserve, it has, in all reality, it has nothing to do with it, and it was something that was predicted all along, and we've been waiting for it to happen. Some of us identified it via technical, some of us seen it more through how the sentiment is looking like, how the market been stretched, cyclicality, you name it. There are so many ways to identify that the market is coming to an edge, which the recent events brought me to think that Michael Burry is not fully involved with technicals as far as I thought, but I do perceive that he does take them seriously to some extent and is aware, but I'm not sure to what extent. The bottom line is that whether it's going to be this event with JP or some geopolitical instability or just simply, it doesn't matter. At the end of the day, if you look back into the history of how the market has behaved always around these sort of events, the market will always find an excuse in retrospect to say, oh, that was the catalyst. In reality, the momentum has shifted over quite a while back, really. And all we have to see now is that the institutions will be liquidated enough for them to start dragging these assets lower and lower, bringing, of course, affecting how the overall indices look like and behave, bringing down the market with it in almost this avalanche-like effect, cascade, if you will. So that is it. That's kind of all I wanted to say. Actually, I was planning to make my coming back video from this supposed hiatus, although those who in the community know, in fact, again, like I said, I have a couple of open spots. It's for an academy whose true value is $10,000 for the academy, which is now has been tremendously upgraded, which now I'm selling only at $4,000. It's basically a steal. It's 60% off. So I highly recommend taking that academy before I bring the prices higher, as the market will be progressing lower and lower, validating and solidifying what I've been saying all along. So yeah, don't waste too much time. Don't miss out on this. Join in the community. Learn exactly why the market is overstretched. What is that cycle? How does it look like? What are the technical tools? What do you need to know? What is more important? What are the harmonic patterns that everyone keeps talking about? How does it all work really? And gain a new actual skill set that will facilitate you actually knowing how the market behaves and why it does what it does. And allows you to be more prepared again. So although this video sort of was meant to be on what to do in this upcoming avalanche that is coming, in reality, I can't really give any solid advice to anyone directly. Why? Because we all have individual portfolios. We literally are running different tests. It's like trying to copy from someone while you're running a math test and is doing a biology test. Trying to copy from someone who's doing a completely different test doesn't make any sense. But what I do provide is the ability to understand what are the conditions, what is bringing about these changes in the market and these shifts, how to identify them with some level of accuracy. Of course, it depends on how deep you want to go. It really depends. If you know, some of our members are able to day trade these recent behaviors, this very volatile market recently, and make gains of upwards of, almost $200,000 within 30 days, within a month, easily. So using these very tools. But so you'll only be able to make your own decisions. I will not tell you what to do. What I will show you is how the measurement tools work, how these facilitate and allow you to identify what is really going on, and then that will facilitate your own decision making, your true correct sentiment to have, and how to operate in order to come out on top, if you will. That is it, boys and girls. That's all I had to say. Well, I actually have a lot more to say, but I'll keep this as short as I can. Love you all. Hopefully I'll see you in the community shortly, because, well, what is coming is going to be clear only to those who truly understand and can anchor themselves into the real reasons to why the market is behaving the way it is. See you in the community. Bye, everyone.